The market is currently closed, and Bigbear.ai Holdings Inc., trading under the ticker BBAI, finished the last session on December 2, 2025, at a closing price of $5.785, marking a decline of approximately 4.38% for the day on exceptionally high volume of nearly 60 million shares. The initial expectation when looking at a 4% drop is usually a clear sign of bad news, a failed contract bid, or perhaps an analyst downgrade, especially in the volatile tech and government services space. However, the unexpected twist here is the context. This sell-off is not driven by a clear, singular negative catalyst, but rather a persistent grinding pressure that reflects the deep-seated tension between the company's recent operational turnaround — yes, they actually achieved a quarter of net income positivity — and the aggressive structural challenges that still dominate the stock's narrative, most notably the significant and active short interest. This creates a fascinating and nerve-wracking situation where good news is treated as an opportunity to sell into strength, a classic tug-of-war that leaves retail traders feeling whiplashed. The general market narrative surrounding BBAI tends to be bifurcated. On one side, you have the AI enthusiasm camp, which views the company as an undervalued player in the high-growth government defense and intelligence sectors, a kind of Palantir 2.0 narrative that often gets bandied about on retail forums like Reddit and X. This group focuses on the potential for massive, high-margin contract wins and the recent, very real strategic maneuver of acquiring AskSage to bolster their commercial offerings and talent pool. On the other hand, the contrarian view, which the recent price action seems to validate, challenges this growth-at-any-cost storyline by pointing to the fact that while the bottom line improved in the most recent quarter, driven by a sharp focus on cost containment and non-operating gains, the revenue was actually down by over 20% year-over-year. This is the reality check that forces a deeper re-evaluation. Is Bigbear.ai a high-growth AI company successfully scaling its top line, or is it a government contractor undergoing a painful transition while trying to keep the lights on through cost-cutting and strategic financing? The steep volume on the down move suggests that large hands are still heavily leaning toward the latter, seeing a revenue decline in an aggressive growth sector as a fundamental red flag, irrespective of a temporary profitability beat. Focusing on the recent stock movement, the dramatic volume on December 2, approaching 60 million shares, dwarfing the average daily figures, highlights an intense level of activity. It wasn't an aggressive flush-out where the price capitulated on thin trading. It was a contested drop. The stock traded in a range from a high of $6.16 to a low of $5.78, indicating that for every seller driving the price down, there was a buyer stepping in, suggesting that the $5.75 to $6 range is becoming a critical battleground for control. We've seen BBAI exhibit incredibly high volatility, with a beta near 3.44, meaning it swings more than 3 times as much as the overall market. This is the profile of a stock dominated by sentiment and short-term trading, a feature that institutional investors, who still only hold around 34% of the float, tend to treat with caution, despite a recent trend of net accumulation. The institutional buying, which saw significant increases from firms like Vanguard and Two Sigma in the last reported quarter, acts as a stabilizing force, but the sheer volume of retail and short seller activity can still overwhelm this stability in the short term. The stock has been trading near its 200-day moving average, a technical level that often serves as a psychological support. But the decisive drop below the daily moving averages suggests the short-term technical picture has become clearly bearish. To understand the core conflict, we must briefly touch upon what Bigbear.ai actually does. The company specializes in decision intelligence solutions, primarily for national security, defense, and intelligence clients. They use their AI-driven platform, which processes massive, often classified datasets, to provide predictive analytics and decision support tools. Essentially, they help government agencies and now increasingly commercial clients make faster, more informed decisions under complex circumstances. Their business model relies heavily on winning and retaining large, multi-year government contracts, which provide stability but can also create lumps in revenue recognition and introduce significant risks related to government funding cycles. The recent contract with the U.S. Navy for maritime domain awareness and the strategic MOU to help build an AI-driven aerospace hub in Malaysia are concrete examples of their capability, but the market skepticism lies in the conversion rate of this contract backlog, which stands at a healthy $376 million, into recognizable high-margin revenue on a timely basis. The entire analysis of BBAI is incomplete without a frank discussion of the short-selling awareness that is driving much of this stock's day-to-day volatility. This is not a stock that is simply being ignored by short sellers. It is actively targeted. The latest data reveals a substantial short interest of almost 105 million shares, representing over 24% of the free float. The days-to-cover ratio, a key metric for potential short squeeze risk, sits at around 1.38 days. While not an astronomical figure that screams imminent squeeze, it is still significant enough to indicate a concentrated bet against the company's valuation. What's particularly telling is that the borrow rate has been relatively low and stable, hovering around 1%, which means that the cost for a short seller to maintain their position is cheap. This low fee encourages hedge funds and professional short sellers to maintain their positions for longer, patiently waiting for what they believe is an inevitable decline due to the fundamental revenue concerns we discussed. You'll find discussions on forums referencing this short pressure, and firms like Citadel Advisors, who, while they still hold a large institutional position, were also seen decreasing their stake in the last quarter, a move that is interpreted by some as smart money taking profits or quietly signaling a shift. The short thesis is straightforward. Bigbear.ai is valued as a growth stock with a market capitalization around $2.5 billion, but it is currently showing the top-line performance of a company undergoing a difficult transition, trading at a price-to-sales ratio north of 13, which is high for a contracting business with declining revenue. The counterpoint, which keeps the stock elevated, is the potential for non-linear growth from a major contract superwin and the immense optionality baked into their AI capabilities. For retail investors looking to understand this dynamic, you must monitor a few things. Firstly, keep a close watch on the official NYSE short interest reports, which come out twice a month. A sharp drop in that number, even on a down day, signals covering. Secondly, track the borrow fee rate. If it spikes above, say, 5% or 10%, it indicates high demand to short, which can precede a squeeze if positive news drops. Thirdly, watch the option open interest, particularly the put-call ratio, which is currently low at 0.38, suggesting more call interest than put interest, a somewhat bullish technical sign despite the bearish price action. You must remain factual and avoid the hype, as chasing a short squeeze based on online chatter is exceptionally risky. What's your take on the rising short interest? Smart money or manipulation pushing fear? Comment below how you interpret this constant short pressure. Looking ahead, the future outlook for BBAI is entirely contingent on two major factors. the success of the Ask Sage integration and, more critically, the trajectory of the commercial revenue alongside a re-acceleration of government contract wins. The market needs to see evidence that the company can execute on its M&A strategy by quickly converting that acquisition into new high-margin commercial contracts, effectively diversifying its revenue streams away from the often volatile and slower government sector. Catalysts could include major non-defense commercial client announcements or an accelerated cash burn reduction that signals a clear and sustainable path to consistent profitability. The risk, of course, is that the revenue decline persists, institutional patience wears thin, and the high valuation multiple corrects downwards toward a level more typical of a traditional government IT services